Hello, team. G'day. Welcome. Today we're chatting about how to build a second income investing. Just going to give everyone a couple of minutes to jump in. And while I'm doing that, just a little bit of housekeeping. Firstly, if someone could please pop into the chat just to let me know that my slides and audio is all coming through okay, that would be amazing. Thank you, Chris. Kylie, yep, appreciate it. Thank you, team. Great. Cool, guys. So, look, as we're going through the content today, please feel free to throw any banter into the chat. Also, any questions that you'd like me to answer, I'm happy to go a little bit off topic and get into as many of those as I can cover. We'll also have some dedicated time for questions at the end, but feel free to please pop them into the Q&A so that I can sort of make sure that they all get covered off. All right, team. So we're talking about how to build another income investing. Essentially, for me, that's like a real key driver of financial freedom and security. And there's a lot of different ways to be right when it comes to investing. Unfortunately, no one set of steps that every person can follow to nail investing for them. But there are some key things that everybody does need to get right, some key questions that you need to ask and answer. So today, what I'm going to do, help you understand the key things that you need to know to make smart decisions when you invest and get the results that you want. Now, guys, so if you're, if this stuff is up your alley, you can check out our other content and events. If you're here, you probably know that we've got a bunch of stuff on Eventbrite, but we've just launched a new series of events on there. There's a heap coming up over the back end of this year and early in the new year. You can check them out, Ben Nash Pivot Wealth on Eventbrite, podcast, How to Be Successful with Money. Check out my TikTok, no dancing on there. Maybe that joke will get old soon, but for now I'm rolling with it. And the other socials, Pivot Wealth website, bunch of tools and resources on there as well. Also, please don't rush out and make any massive decisions off the back of what we cover. Strongly suggest you seek out personalized advice before jumping in, particularly when it comes to investing. And I'm going to talk about some of the considerations around this in more detail today. But particularly when it comes to investing, if you're setting a broad direction for what you're going to be doing with your money over the next little bit, important that you want to know what's what before you get too far down the path as well. All right. So, look, guys, for anyone that's been following our content for a bit, you may have heard me say this before, but I feel like it's worth calling out specifically around investing because there are some really common challenges that hold people back when it comes to building another income investing. I think everyone knows that you need to invest. You know that investing is important, but these challenges really can push you into the inaction trap and mean that you're not investing at the rate that you should, that you're not building the momentum that you should, and not obviously then getting the results that you want as well. So information overload, it's like there's so much information out there, so many options. It's like we're drinking from the fire hose, hard to know who to listen to and who to trust. The second is people struggle to find balance between, how quickly you build your income investing and living an awesome lifestyle at the same time. Balance is important, but not easy to find. And FOMO, or the fear of missing out, is a big one, but also the fear of making a mistake, the fear of doing something dumb that costs you a bunch of money. And what happens as a result is you end up stuck. You end up stuck not doing nothing, but stuck doing the same thing that you've been doing in the past. And you're missing the opportunity to be getting better results, getting more out of what you have right now. So there are three things that you need to get right if you want to be successful with money, and then one approach to planning, which I'll unpack later on. Structure, strategy, and solution. So structure is about having a system where you're making it easy for you to save and manage your money day to day, but making it clear how much money that you've got to work with when it comes to building another income investing. Then you got your strategy. That's all about understanding the different pathways it can take you from where you are right now to exactly where you want to be with your money, and breaking that down into a really clear action plan so you know what your next steps are, and when they're happening, feel like you're on top of things. And the third is investments and the solutions that you use to back up your strategy. So getting reliable, consistent progress over time and avoiding those big setbacks and those momentum killing mistakes. If any one of these three elements is missing, it ends up dragging down the others, like no structure, working with a leaky bucket, no strategy, leaving money on the table, bad investments, blow up your cash. So you need to get all three right. today we're focusing in on the solutions piece, but I'm going to give you a bit of insight into some of those other areas as well, so that you know what to look for there. Before I get into that, though, I wanted to cover some of the myths and mistakes that people make when it comes to investing. So firstly, some myths. First one is that shiny brochures, or more so these days, slick marketing, does not equal good returns. Now, there's a bunch of investment companies and managers out there that have really great marketing. Some of them also have really great investments, but others, they're just really great at marketing, but there's not a lot of substance behind the shine. So I think you just want to be really careful and when you're choosing your investments. I think good marketing, good user experience, good brand messaging, that's all important, but it's not enough on its own. So you need to make sure that whoever's you're managing your investments for you, that they've got that substance behind the scenes. Now, in order to have that confidence to know, you need to know enough about investing so that you can figure out what's bullshit and what's the real deal. Investing risk is not with the manager, and this one gets a little bit complicated, but what I mean by this is that in Australia, all managed investment providers, so long as they've got a product disclosure statement and a financial services guide, they're protected under APRA, who's the Australian Prudential Regulatory Authority, who are the regulators that oversee financial markets. Now, their main job, or one of their main jobs, is to protect investors when they invest their money, and they do a very good job of it. What that means is that if you use a micro investing app or an online stockbroker or any other sort of financial managed investment provider, they never touch any of your money, such that it doesn't really matter which company you use. It only matters the actual investments that you choose, that you select within the product that you're using. For example, if CommSec was to go bust tomorrow, even though that's highly unlikely, not a single dollar of their investors' money would be compromised, because CommSec don't actually hold their money. They've got like what's called a third-party custodian, which sits on the side, and they make sure that the money is all nice and secure and safe, and the shares are secure, so that if CommSec was to go bust, it means that all of the CommSec members would need to find a new administration provider to collect their dividend checks and do the annual tax statements or whatever. The reason that that's important is because when you're choosing an investment provider, a common thing that I see that stops people, they might find someone that they really like, but they don't want to pull the trigger because they're worried that it might be a newer company, and they feel that their money is not safe. That's actually just not the case. Look out for the financial services guide and the product disclosure statement. So long as those things are in place, know that your money is protected, and just really the important part is the investments that you ultimately choose. The other thing is that you do not need to shoot the lights out with every investment that you make to make great money over time. It's really natural as investors that when you're starting to invest and you're choosing the investments that you're going to include in your investment portfolio, you want to get as much of a return as possible. But for mine, if you're somewhere today and you've got somewhere that you want to get to from a financial perspective, your question really shouldn't be how do you get there as quickly as possible, but give yourself a 50% chance or a massive chance of suffering some setback that's going to mean you have to go back to the starting line. Instead, you should be saying, well, how do I get there with the highest degree of certainty possible? And what that doesn't require you to do is choose investments that are going to shoot the lights out and get some crazy returns, because that probably comes with more risk than you actually need to face to get the results that you want. You don't need an advisor to invest. That's another common myth or question that people have. An advisor can help you, choose the right investments, formulate your investment strategy, set up investment products, but you don't need one, particularly these days as technology gets better. There's more and more solutions that are really quite good on the investment side, that if you know what you want to invest in and you know how much you want to invest, then you don't need an advisor in order to do that. Going through some of the investing mistakes that I see people make, the first big one is making choices in isolation. And I think the most common question that I get asked as a financial advisor is to say, hey, I've got $10,000. What should I do with it? Or where should I invest it? And the right answer is always that it depends. what you want to do when you're making your decisions is make sure that the investments that you're making fit in with all of the other things that are going on with your money, so that you don't end up with an investment that's a good investment in absolute terms, but ends up being a bad investment for you. Now, this is not a share investing example, but one that's front of mind from clients that I've been recently chatting to. These clients that bought a property, they bought this lovely property in Five Dock. It ended up making them a bunch of money, but it turned out to be a shocker of a decision for them, because they essentially hadn't planned around starting a family, maternity leave, childcare, return to work part-time, those sorts of things. So they ultimately sold this property. They were forced to sell the property so they didn't have to make serious sacrifices to their lifestyle. They made money on the property, but then they ended up out of the property market for the next 4 years. They only just got back in and ended up paying more for the same property. Now, again, it's not a share example, but it shows where an investment can make you money and be a good investment, but end up being a bad decision for you. So instead of just doing stuff, you need to make sure that the investment that you're doing fits in with your bigger picture. And for these clients, that if they had just spent $100,000 less on this property, then they would have been able to hold it over that period of time, and they would have made an extra probably $500,000 from being in the market. So again, you've got to don't make choices in isolation. Make sure that they're part of your bigger picture. The other thing, and this is a really common one around investing, is seeking out the very best option when it comes to your investing, and typically comes from engineers and teachers or the super analytical people looking at, yields versus growth returns versus all of these factors and trying to find the thing that's the best. But we never know what the best is until after it's happened. And if you delay taking action looking for the best, it's likely that you're missing the opportunity to actually making progress and building your momentum. And look, unfortunately, there's no such thing as a set and forget money strategy these days, because everything is changing so quickly. Particularly, if the last couple of years have taught us anything, you see the rate of change around what's going on in financial markets around the world, what's going on with everyone's personal financial situation, and what people want, what you want, how you want to live your life, and what's actually important to you. So you do need to take action, but unfortunately, there is no set and forget strategy. It shouldn't need tons of work, and you shouldn't be doing a full 180 on your strategy every couple of months, but looking at what you're doing, making sure that you're thinking about what's important to you, what's going on with your money, what's going on in the world, is going to mean that you're in the best position to continue to get the most out of your money. And the last one is advice with an agenda. And look, this comes a lot in the investment space, because investing in property, the two main areas where there can be a lot of conflicts of interest, whereby the people are sort of advocating certain approaches or pathways or even advising, and there is that conflict that can compromise the quality of the I suppose guidance, education, information that you're actually getting. So you want to understand, and these conflicts generally need to be disclosed. You should ask lots of questions though at the front end when you're ever talking to anyone about your money, so that you can understand what conflicts might exist and how they might influence the advice that you're getting. That way you can be better placed to make better decisions. Got a question here that says, can't we apply set and forget towards ETFs? Look, that's a really good question. And I think that in some ways you can, but in other ways you can't. And what I mean by that is that if you choose a particular investment approach that you're comfortable to follow and comfortable to follow for the long term, say it's index investing, for example, you say, look, I know that I want index investing. I know that I want to use, say, the Australian index, just not saying that that's the best strategy, but just as an example, if your preferences around investing never change, then that investment never needs to change, that you can continue adding to and buying more of that ETF over time and building that up. But as your personal financial situation changes, your income changes, your expenses change, your commitments change, and your wants change, as well as when what's going on around the world and with investment markets, when that changes, then you should be looking at, how much are you investing, whether still, investing at that level is the right amount. If you should instead be maybe selling down some of your ETFs and buying an investment property, or maybe you should be restructuring through super. I'm just making these things up. I'm not saying that that's the best strategy, but all of these things that you go, well, actually, maybe now, because interest rates are 5% instead of 2%, I should focus on paying down my mortgage a little bit more instead of investing into that awesome Australian share index ETF that I'm confident that I will continue to invest in the future. But the right move at the wrong time is the wrong move. So it's more about the broader strategy that you don't want to set and forget on than the individual elements of that strategy. I hope that makes sense. Oh, you're welcome, Sam. No worries, mate. So, look, I wanted to talk a little bit about structure, and I won't spend too much time here, but I wanted to call this out, and apologies in advance, because I know that budgeting and banking is probably the least sexy part of your money strategy, and it's not the first thing that comes to mind when a lot of people think about building an income investing. But I'll explain why it probably should be, and how having a good budget, a good savings plan, and investment plan can help you make better decisions and get better investment results. Now, ultimately, when you're allocating your money, whether it's savings that you've got in a bank account that you're looking to invest, or regular spare income that you have from investments, from your salary that you might be looking to invest, you've essentially got two choices. You can allocate that money to your spending today, or you can allocate it to your spending in the future. Now, your future allocation is your savings and investments. When it comes to essentially your wealth building options, when it comes to wealth building, there are 6 options that are available to each and every single one of you and every single one of the billions of people around the world. You can save money in cash, and you can pay down debt. They're the first 2 options. They're the 2, pretty boring, but pretty safe and pretty comfortable type options. And then the other 4 are the actual wealth building options, which is buy shares, managed funds, or ETFs. I put them all in the same bucket. Buy property, and there's a lot of different ways you can do that. Buy crypto, and you can crank your superannuation or retirement fund. It's not rocket science what those 6 options are. The nuanced part, and I suppose the valuable part for most people to figure out, is what is the right combination of those options to get the results that you want. And the first 2 options, save money and pay down debt, they're 2 important options, but they will not make you rich. Paying down debt will not make you rich. And then saving money in a bank account, you're not going to get rich doing that, because the long-term return on cash is low. It's really those other 4 options that are the growth type investments: buying shares, buying property, buying crypto, investing through your super. They're the things that are going to help you build more wealth over time, but they're also the investments that go up and down a lot in the short and medium term. So in order to get great results when you invest in any of those 4 areas, there are 2 things you need to do. The first thing you need to do is make sure that you're choosing good investments. And I'm going to talk you through exactly how you can do that as we go through in the next section, in fact. The second thing that you need to do is to make sure that you're never forced to sell those good investments at a time that doesn't make sense. Because if you could have the best investments in the world, but if you were forced to sell those investments in the middle of the COVID pandemic, for example, or the GFC, or the market disruption that we're seeing at the moment, you're going to probably be taking a haircut on those. So how you make sure that you're when you allocate money from the today to the future side of things, that you're never forced to bring it back to the today side, is that you need to make sure that all of the spending that you want to do on the today side of things is provided for. It's pretty simple, not necessarily easy, but it's pretty simple. Now, there's only so many types of expenses that people have. You've got your fixed costs, rent, bills, boring stuff. You've got your spending, that's your walking around money, meals, entertainment, clothes, shoes, those sorts of things. Debt, everyone's least favorite category. Lifestyle, that's your savings to spend. Travel fund, home renos, tech toys, bigger ticket, but also discretionary. Now, at the end of the day, you've only got so much money to work with. So the ideal, well, I don't even know why I'm doing that, but it's the actual ideal strategy for you is the one that gives you the right balance between you spending as much money as you want today, while you're also saving as much money as you want for the future. So when you're doing a budget, doing a spending plan, saving plan, whatever, the first thing you need to do is list out all of the money that you're spending, look at what's left over for saving, and then keep balancing things around, reprioritizing, deprioritizing the things that are less important, prioritizing up the things that are more important, till you get to a point where you're happy with how much you're spending and you're happy with how much you're saving. Once you do, you need a system that makes it easy to get the results that you want, because I think we've all done budgets that don't work. So if you've taken the time to get a great savings plan in place or a great investment plan in place, you need to make sure that you're able to get this investment or savings results that you want. Now, I'm a big fan of the bucket system, where you've got the right money in the right places at the right time, multiple bank accounts, using the power of small barriers, and you have money coming in automatically going to where it needs to go. What this gives you from an investment perspective is that it should give you a ton of confidence that when you allocate money to the today side, so long as you've done when you allocate money to the future allocation, wealth building investments, so long as you've got all the today stuff provided for, you should never be forced to sell investments at a time that doesn't make sense. And then you're able to let your investments do what good investments do over the right amount of time, which is make you a bunch of money. As I said at the start, it's not a super sexy part of your strategy, but it is a really, really important one. And it does sort of dictate what you should be doing on the investment side. Also, today we're talking about mainly shares and listed investments. But when it comes time to buying property and taking out $1 million mortgage, if you've been running a system that looks anything like this, it's going to give you a lot more confidence to pull the trigger, rather than you just hoping that you're able to save, whatever amount you think you might be able to save every week or month. So maybe not super sexy, but it is super effective and important to get right when you lead into your investment decision making. So with that in mind, I suppose I want to cover investment basics and the building blocks of how to formulate an investment strategy. Before I do, though, I'm just going to share an example with you about why this is important. And I want to show you the power of time and how investments can grow over time with the market. Now, what I've got, before I throw all the numbers at you, is essentially, a lot of people think that you need a lot of money to get started investing, but you absolutely do not. What I've got is an example here where you start with $0 in your investment portfolio today, and you save and invest $1,000 every single month. $1,000 a month, 12 months over the year, $12,000 every year. You do that over 10 years, you would have put in a total of $120,000. Now, I've used the 30-year return on the Australian share market, which is 9.8%. So if you had done this 10 years ago, you would have put in a total of 120 grand, but you would have got some dividends on the shares. You would have got some growth, some increase in the value of those investments over time, such that the $120,000 that you put in would now be worth around $202,000. Now, if you kept that going for another 20 years, 30 years, 40 years, so 10-year periods, that in 20 years, you would have put in a total of 240,000, but you can see that the compounding is kicking in now, so that your investments would be worth $740,000. If you keep it going for 30 years, you would have put in a total of 360,000, but your investments have accelerated now to $2.16 million. 40 years, you put in $480,000, but you've got almost $6 million in your portfolio. Now, guys, this is starting with $0 as a starting point and saving $1,000 every single month. If you were to save $2,000 a month, every number on here would double. This shows the power of time for sure. And you can see that as time goes on, that in each period, you're just massively multiplying the returns that you get. But it also shows the power of getting started, because and this is my next point here, that you have to get started, because a common point that happens, people know that they want to invest, but they're fearful, don't want to do something dumb, worried about making a mistake, worrying about costing themselves a bunch of money, but then they end up doing nothing. And this fear leads to inaction, and it leads to missed opportunities. So the sooner you can get started, the better off you're going to be. And the opportunity cost for every single one of you guys in not taking action today, or not taking action this week or this month, is losing time that you could be using to build momentum that you essentially never get back. So Getting into the basics, the first thing that's important for you to understand and get clear on is your investment mix, and specifically the mix between growth investments like shares and defensive investments like cash. Now, this in financial planner land we call it a risk profile, but it's essentially how much do you have in growth investments versus how much do you have in defensive investments. I'll unpack each of them in turn, and there's essentially um, five different asset classes that go into this mix in the way that I've unpacked it here. The first is cash, and with cash, excuse me, with cash, they call it a defensive investment because it's less likely to go backwards. In fact, in Australia, cash is government guaranteed up to $250,000, so you know that that money isn't going anywhere. It's also not going to shoot the lights out from a return perspective, though, and the long-term return on cash is like 4%. That's over the long term when inflation was running consistently higher. So I think that would probably come down, although with the current inflation crisis, I suppose we'll see. Then we've got fixed interest. That's essentially like a term deposit or a bond, corporate bonds, government bonds, those sorts of things where they generally pay a slightly higher return, but you also lock your money away for a period of time. So there is a little bit more risk involved. Then you've got property investments so those are the two defensive investments. Defensive, stable, income generating investments. Defensive investments generate income, interest income from a bank account, whereas growth investments, they're designed to grow. Property, Australian shares, and international shares are the most common ones, where you buy an investment or an asset in those areas. You might buy it for $10, $100, $100,000, $1 million today, and you hope that over time it grows to be worth more than that. When that happens, then over time, you're going to get more ups and downs in the value of those investments. But over the long term, the returns of growth investments should be higher than the return on defensive investments, essentially. Now, choosing the right split, the right mix and allocation between defensive and growth investments is all important when it comes to what is the long-term return that you're going to get on your investment portfolio. It also ties in with your investment timeline, because with any growth type investments, you're subject to the market movements. And what they say for share investments, they say that you should, if you invest in shares, you should be prepared to leave your investments for 7 to 10 years or more, if the market suggests that that is what makes sense. And the reason that they say that is because, like, when the global financial crisis happened in 2008, markets went right down and they stayed down for a long time. That's typically what happens. Now, I know that in COVID, the markets fell off a cliff, but then they recovered really quickly. That's quite an uncommon downturn. What happens in basically every other downturn is that the markets go down and then they stay down for a while before they eventually recover. Now, even though the suggested investment time frame is 7 to 10 years, it doesn't mean that you should want to hold your investments for 7 to 10 years to get those results. And where I see this is particularly in Australia, buying your first property is expensive. People are trying to build up a deposit so that they can get into the market. You reach this tipping point where you got $50,000, $100,000 in a savings account, and you realize that it's actually not working that hard for you and you want to do something more with the money. Now, if you invest into the share market in that case, it's possible that if there's a significant market downturn straight away, your money's going to go down and stay down for the next 5 years. So you need to be prepared that it's going to be a terrible idea if you invest to sell that money. Yeah, you have to be ready for that. But if the markets keep going up and your shares are up, it doesn't mean you should want to or have to or actually leave the money invested over that period. If the share market goes down, though, for someone in that case, in my view, you can continue to invest more while markets are down. And then when markets ultimately recover, you end up getting more of that upside. But understanding investment timeline and how that fits in with the other things that are going on with your money is all important. Got a question from Alyssa, says, are you likely to make those amounts over time, the 9.8%, or are there potential risks? Yes, there are potential risks. These are the risks. The things that I'm talking about now are those risks. I might actually just defer that question just for a sec, Alyssa, because I'm sort of stepping through the basics, and some of this stuff I appreciate that people probably know, but I'm building on it to the types of investments, and then I'll talk you through where that return actually comes from. So, not all risk is made the same when you invest, and there's good risk and there's bad risk. And in this slide, I'm talking more so about big company risk versus small company risk. If you imagine Commonwealth Bank are the second largest company in Australia. They have massive revenue streams. They've got over $1 trillion in underlying assets. And they are subject to market movements. The value of CBA shares go up over time, the value goes down. Over the long term, they go up. CBA is a stable, what we call a blue chip company. It's a big, high quality premium company because it's got all of those assets behind it, because it's got a 100-year track record. So it means that an investment in CBA is much more stable than an investment in a tiny company that just started last month. With a small company, a startup company, the returns are going to be much more up and down. And the returns, they might shoot the lights out, but you might actually go bust. Now, one thing that stops a lot of people from investing and investing more and investing as much as they should is that they think that when you go all in on shares or managed funds or ETFs, that you're actually getting heaps more of these small company shares in your portfolio. That's actually not the case. It just means that you're getting more growth investments like shares and less defensive investments like cash. So in my view, particularly when you're in the early days of building your investment portfolio and building your investment income, if you stick to the bigger companies, the more stable blue chip companies, it means that your return is going to be much smoother. Plus, you should have more confidence in what you're doing and be able to sleep at night better because you're not banking on some startup shooting the lights out or succeeding where the majority of them fail. You're just banking on companies like Commonwealth Bank being here in 100 years from now or 10 years from now. So not all risk is made the same there. Now, diversification is another really important risk management strategy. Really simple, but really effective as well. All diversification means is spreading out your risk. Now, in this example, you can see on this slide that there's company one and company two. One of them might be CBA that I just mentioned. Another one might be, say, Woolworths, for example. Woolworths is another big, stable, what I'd consider blue chip company, but it is a different company to CBA. So the return profile is going to be different. Now, if you got $10,000 and put half into Commonwealth Bank and half into Woolworths, then the return that you're going to get on your $10,000 is going to be the average of the two returns. When Commonwealth Bank's doing really well and Woolworths is doing not so well, your return will be in the middle. When Woolworths is doing really well and Commonwealth Bank's doing not so well, your return will be in the middle. And that's why that line you see is smoother. The more diversified you are, the smoother your investment return will be over time. Now that shows with two companies. If you put 20, 200, 2,000 into your portfolio, then the smoother and smoother and smoother your returns get. You will still see ups and downs. So I don't want to make out like you can diversify away the potential for any downturns, but the more spread out your investments are, the less your overall return is dependent on the return of any one particular company. That means if one company goes bust, it has less of an impact on your overall return. Whereas if you're just invested in one company, it means that your total return is just the return of that company. If that one company goes bust, you unfortunately lose all of your money. Now, this is the Australian share market, or at least it was when I put together this graphic. The market composition has changed a little bit slightly coming out of the back of COVID, where CSL, Commonwealth Serum Laboratories, is now the biggest company in the country, having gone ballistic after COVID with all the vaccine stuff. But essentially, this is the market. This is how the market is composed. You know how the And what I'm talking about is the ASX 200, which is the 200 largest companies in Australia. It's like when you see the news at night, or you jump on Yahoo Finance, or if you watch the financial news, you look and they say the share market's up or the ASX is up. Then it just means that the combined value of all of the companies that make up that market are up. It might mean some have gone up, some have gone down, but overall, the total combined value of all those companies has gone up. Now, we know what those companies are. We know how the market is composed. That's all publicly available information. At the time that I put this graphic together, Commonwealth Bank was the biggest company in the country. Its value was $199 billion, and it was 9% of the share market overall. Then you got Westpac. You can see the big banks, NAB, Woolworths, Wesfarmers, CSL, Telstra, all in here. And we know what the composition is. Now, with an index fund or a passive index fund, all they do is that they get a pool of money, and they invest in exactly the same percentages as what the actual market looks like. And that's why the return on an index fund is basically identical to the return on the share market overall. The alternative to this is an actively managed fund, an active or passive. That's the biggest investment choice you need to make when you're choosing your investment philosophy. An active fund is where they're trying to perform differently, or generally better or differently to the market overall. So they might say, well, actually, we don't like CBA. We like BHP. So we're going to put 8% with that. We like Google, Apple, NAB, whatever. And they choose certain allocations, trying to perform better or differently to the market overall. Now, the issue with active funds is twofold. Firstly, no one knows the future. And the stats show that 95% of active funds fail to outperform their active counterparts. The other part is, and part of the reason for that poor performance is that actively managed funds are much more expensive than passive funds, because a passive fund just needs a computer algorithm to get the market data and make sure that the portfolio stays the same as what's publicly reported. An active fund has the teams of analysts and economists and the fund managers that are trying to find, these deals and trying to perform better. So there's a lot more expense that's in that. And that's a big detractor on the performance of those funds over time. And small changes compound to be a big difference over time. Now, to Alyssa's question, saying, will you receive that 9.8% return? So the 30-year return on the Australian share market is essentially the 30-year return on an Australian share index fund. So yes, there is market risk, there's interest rate risk, there's company risk, there are risks in there. But with an index fund, you know that it's always going to do exactly what the share market overall does. So that means that you should have a lot of peace of mind to sleep like a baby. And this is why I like index funds for myself personally, and why we recommend them quite a lot with our clients. So we know that that return will be received. Comment from Josh that says taxes take a big chunk out of the projected growth. Yes, look, I suppose you're probably right. But look, the rough rule of thumb when it comes to building an investment income is that you should be able to draw 5% from a portfolio of assets without eating into capital. So what that means is that if you've got $1 million invested in a share portfolio, you should be able to draw $50,000 a year, inflation adjusted, for the rest of your life without eating into capital. How you get there is that 9.8% return that I mentioned. You take out 2.5% for inflation, and then you take out 2.5% for fees and taxes, and then you're left with 5% year on year on year. So if you know that you want a passive income of $100,000 a year, that means you need $2 million in a portfolio in order to deliver that. So yes, taxes are there, but there's still plenty of room to make good money over time with that as well. Kat says, what are your thoughts on buying separate shares in blue chip stock if an ETF you have contains the same stock? Is it sometimes worth double dipping? Look, I'm not a big fan of buying individual companies, because I think it's not very diversified. It's got a lot more risk choosing one company than just choosing the market that you want to invest in. So yeah, I suppose it really depends on what it is that you're trying to achieve. I think overall, if you really feel that, you know, Commonwealth Bank is the very best investment that you can buy, and you've got an ETF that's got some Commonwealth Bank in there, and you want to double down on Commonwealth Bank, then you can. That's basically the question is what's the best, really leads to sort of like what's the best investment strategy, and there's no one right answer. We probably know in hindsight if we look back in 5 years and test the hypothesis. It's just that no one knows today. I hope that makes sense. Another question that says, as a newbie to market, I'm not really following this question. Is there a capital guarantee if I invest in passive funds? What is the best medium for me to invest in passive funds? So maybe this point will answer that, or Ram, if there's something to follow up, maybe just let me know. Essentially, there are four main ways that you can access these investments. Four and four plus one other one, which I'll touch on. You can buy direct shares in companies, so where you buy one single stock in one single company, and you get access to that company. That can be good because if you find a company that you feel is, or is going to perform really well, then you can buy shares in just that holding. With a managed fund, though, it's a pool of investors that are all investing into a whole bunch of different shares. So managed funds can be great, and similar to ETFs and some micro investing options as well, where you buy one investment and that investment invests into a whole bunch of different underlying investments. That means that you get instant diversification, you get cheaper costs, access to wholesale markets, etc., etc. So there are a few advantages there. With an ETF, ETFs are bought and sold like shares on the stock exchange, very similar to managed funds, except for the fact that they are traded on the stock exchange. Also, there is a slight difference in the tax consequences. It gets quite complicated, but essentially with an ETF, you own tiny little slices. If you own the ASX 200 ETF, you own a tiny little slice of every one of the 200 largest companies in the country. If you never sell your ETF over time, you continue to hold those shares, and you only pay capital gains tax when you sell. With a managed fund, because it's a whole pool of investors that are invested into the same fund, if another investor is buying or selling, then you can accrue or wear capital gains tax as a result of doing that. You can also use micro investing apps, which started as a way for people that were just beginning investing, but as the technology gets better and as the fees get cheaper, becoming more of a compelling conversation to allow you to access shares, managed funds, and ETFs, but do it in fractions such that you can invest $5 into a share in Apple, or you can invest $5 into an ETF that costs $25 generally, and you're just getting fractions of those shares. The other one that's not on this list, which is, for the purposes of completeness, is listed investment companies, or LICs. That's where you buy a share in a company that invests in the shares in other companies. Gets a little bit complicated. Listed investment companies can be good, but in my view, they're probably not worth it for a lot of people, because you can get better options, in my personal view, from managed funds or ETFs or micro investing apps. Now, what I would say is that if you've got less than $200,000 invested in your share portfolio, then the differences between micro investing, ETFs, managed funds, listed investment companies, going to be very, very small in terms of your bottom line. At the lower end, you probably wouldn't notice it at all. At the higher end, you might notice it a little bit. Even at $200,000, still pretty minute. What that suggests to me, and I suppose to the question that's out there, it's like, I think if there's not a lot of difference in the bottom line returns that you get from choosing a passive ETF versus a passive managed fund, then you probably shouldn't spend too much time thinking about which one of those is going to be best. You should just find one that's easy for you to use, easy for you to set up, easy for you to automate your regular investments, and then just get into it guns blazing, because you know that you're going to at least be then getting the results, instead of just trying to pour over these differences and getting yourself in a spin, burning a whole bunch of time without any actual real tangible benefit for you as a result. So yeah, focus on a solution that's easy. Now, choosing, like when you choose investments, tax is critical. It's the biggest opportunity and it's the biggest roadblock. So I wanted to talk a little bit about some of this. The after tax return is really all that matters on your investments. A lot of people don't think about tax, and that's because tax is essentially hidden there. Until you do your tax return, you don't always see the tax that applies on your investing, but you only get one tax rate. And your investment, so therefore, like investments that you own in your personal name, all of the income and capital gains that are generated by those investments add on to whatever your salary or employment income is, and then you're taxed at your marginal tax rate. But there are different tax rates for different entities. Now, firstly, I just wanted to unpack the marginal tax rates in Australia. First $18,000 of income you earn, you don't pay any, you pay zero tax. Above 18,000 and up to 45,000, you pay 19% in every dollar you pay tax. 45 to 120,000, you pay 34.5%. 120 to 180,000, you pay 39%. And above 180,000, you pay 47%. Now, what that says is that if your salary or employment income is above $45,000, every dollar of investment income you earn, you're only paying 30, you're going to be paying 34.5% of that out in tax. If you earn more than 180,000, then you're paying basically half. So that's a significant chunk that's flowing out of your investment return in tax. And that's why I say that the after tax return is all that matters. Now, you don't have to invest just in your personal name. You can invest through other tax entities, which I'll unpack, or for individuals. And I see this quite a lot, that you see a couple where one person is on a much higher taxable income and a much higher marginal tax bracket. And then they're holding all of these investments in their name and not in the partner's name, who has a much lower tax rate in a lower tax bracket. Now, being strategic with who owns what investments can make a significant difference to the bottom line in terms of the after tax return that you receive. So, being smart there, that should be a really easy one. Then you've got superannuation. And I get that super isn't likely to be the first strategy that most people go to when it comes to, investing, because of the fact that your money is trapped in super until you're at super retirement age. But given that the maximum rate of tax that applies on superannuation is 15%, you can see that the super tax rates are so much lower than most people's marginal tax brackets, which means that if you're investing and only paying 15% tax compared to 35% or 47%, your after tax return is going to be way higher, meaning you've got way more money that you can grow and compound over time. Then you can also invest through a proprietary limited company. Anyone, so long as you're not on like an ASIC blacklist or anything like that, can go and set up a proprietary limited company and open an investment account in a company. And then the maximum rate of tax that applies is 30%. Particularly for higher income earners, that 30% tax as opposed to 47% makes a massive difference. And then you can invest through a trust that allows you to stream income to other tax paying entities. Now, I wanted to unpack and show you the difference if you're investing in an investment company versus investing in your marginal tax rate, assuming that you're in the top marginal tax bracket. If your investment income is $100,000 a year, if you're paying tax at your personal tax rate, you'll pay $47,000 tax on that income. If you invest through a company, you would pay $30,000 in tax. So the tax saving is $17,000 per annum every single year for someone in that slot. If you've got $200,000 of investment income, 300, 400, you see that it's the tax savings are in the tens of thousands of dollars every single year. Now, this is serious money, but the same logic applies that if you're because commonly when people are trying to build an income investing, it's not because they want or need an income from investing today. It's that they're trying to build wealth and build up an investment portfolio so that they can live off that income in the future. So you don't need the income so you don't need access to it. So building investments through like a trust and or company means that you can grow in a tax effective way until the point where you need to and want to live on that income. And then you can start drawing it. You pay yourself a salary from your company or your trust, and then you can earn $180,000 from your own investments without paying more than 47% tax, and your investments have grown a lot faster. So it can be a really effective strategy. Chris says, stage 3 tax cuts, if unaltered, cap 30% marginal tax rate up to 200,000, same as company tax rate. So it negates need for company for most people from 2024 onwards. Well, yeah, if you're earning less than, if your income plus your desired investment income as you're building your wealth is less than $200,000, then you're not going to receive any benefit from using a company. If your income though is say $150,000, and your ideal investment income that you're trying to create is say $150,000, what that means is that you're going to then, if you build that all in your personal name, your assessable income is going to be $300,000, and $100,000 of your income is going to be taxed at the top marginal tax rate of 47%, rather than the 30% tax rate that applies in a company. So yeah, but if your salary is $50,000 and you're trying to build $50,000 of investment income, then yeah, you don't need any structures like that. And it's important with these structures that you've got to make sure that the benefit that you get from setting up a structure is going to be way more than the amount of that you actually pay for it, all the time that you're going to have to spend in running the admin around these things, because they are getting easier, but does still take some doing. And yeah, look, investing is the biggest area that you can do to save tax. Now, I want to talk through planning, and I'll just give you the short version of this. But essentially, when you're planning with your money, key steps to go through when you're planning your investments to make sure that you get the right results when you invest. The important part here to drill into the detail is really when you're making decisions with your money, you want to really understand how your money is flowing today, so that you've got what money's coming in, what money's going out, what's left over, and then looking at what's going to change over the foreseeable future, particularly if you've got bigger shifts around, kids costs, mat leave, pat leave, time out of the workforce, part-time, childcare, schooling, temporary costs that are important today, or that aren't important today and will be important in 2 years or 5 years' time, but then will go away over time. So you need to know what those things are, because that gives you a baseline that you can then start layering different decisions over the top of. You can then look at, okay, well, how much money do I have left over to invest? And then what does that mean? What if I buy property? What if I pay down debt? What if I crank my super? What if I do some sort of combination? They're all going to have different financial outcomes attached to them. And you want to know what those financial outcomes are, so you can think about what risks are attached to them, so that you can make the best decision for you. It's not just about the numbers, and it's not just about how you feel. The important part is the balance between the two. So figuring that out, something that's all important. Then you get clear action plan, and the end result is that you know what your next steps are when they're happening, and you feel like you've got a clear path to take you from where you are to where you want to be with your money. So guys, look, next steps, and I wanted to sort of unpack this, again, an example around the power of compounding that talks about how to replace the average income through investing. Now, in Australia, the average income is $92,000 a year. Using that 5% rule of thumb that I mentioned before, if you had $1.84 million in an investment portfolio today, that should give you $92,000 in the next 12 months, and mean that you're getting $92,000 a year, inflation adjusted, for the rest of your life, using that 30-year return on the Australian share market of 9.8%. Now, how much you need to actually save to get there? Well, it depends on, where you are and when you get started. But what I looked at is that if you're saving, so if you're trying to get there by age 60, if you're 20 years old today, you need to be saving $10.10 every day to build your $1.84 million portfolio. If you're 30, you need to be saving $27 a day. So you see, you wait 10 years, it's more than double the amount that you need to save. You wait till you're 40, it's $81 a day. That's like $500 a week, and it's getting challenging at this point. If you wait until you're 50, you need to save almost $300 a day, which at $2,000 a week, that's going to be almost impossible for most people unless you're on a super high income. So the sooner you get started, the less that you have to push. And I suppose this sort of talks into this model that I wanted to share with you, talking about getting from where you are to future state with your money. Essentially, in the future, every single one of you is going to be somewhere between doing really bad and doing really good with their money. When you think about getting from where you are to future state, though, people think about their progression like a straight line, but because of the compounding impact of time and money, it's actually a curve. So if you're not 100% on track to end up exactly where you want to be, you need to do some stuff. You need to start that investment plan, set up that savings account, ditch that credit card debt, whatever. And once you do that stuff, then you just need to take the next step and the next step and the next step, which is easier because you're following the bouncing ball, because you're on the path. But the sooner you leave it, the more time goes on, you see that jumping the line becomes more and more painful, and putting yourself in the best position becomes impossible. So if you want to save, if your target is replacing the average income of $92,000, then that's your target. You need to save X dollars today. If you wait a week, a month, a year, 5 years, then it's just X plus plus plus. So you just have to do more and sacrifice more to end up in the same spot. So the sooner you start, the easier it's going to be, the less you need to sacrifice. So guys, look, that's it from me for today. Look, this is it. This is the stuff that we help people with. So if this stuff strikes a chord and you want to chat through how we can help, then you can hook us up one of these 10-minute calls. I'm actually just trying to find the link to pop it into the chat, which I've just done now. 10-minute call where we can help you answer your money questions, figure out what your next steps are and how to get started. If we think we can help, we can talk about how. If we can't, we can point you in the right direction. And I know that sometimes people just need a push. So, please feel free to get around that. Also, check out our upcoming events and sessions. There's a bunch of stuff that's happening, particularly over the next couple of months as well. Guys, that is it for me from this time. I will catch you on the next one. Bye for now.